I know we're a little bit later in the day today, so if you are joining live, appreciate you staying up with me. It's been a busy one, but excited to talk a little bit more about earnings today, particularly one item that I think has been pretty heavily overlooked. We'll talk about a couple of things, but one thing in particular that I think is pretty exciting. So before we get into that, just looking at the stock, of course, following earnings, Tesla down about 6 2/3% today. The NASDAQ down just 0.6%. So pretty rough reaction to the earnings report, kind of similar to what we had seen in after hours yesterday, kind of in that range. Looks like after hours today even falling a little bit more. So I think right now we're seeing a couple things. Reaction to earnings, really that top line miss driving things, I think. And then like we had talked about yesterday. And I think we're still in that Twitter overhang situation. A bunch of articles out today on, what's going on there. I think a lot of the people are wondering, okay, was Elon Musk yesterday talking positively about Tesla because he's trying to offload some stock here in the next couple of days after the earnings report and before the Twitter close? I have no idea, but to me, that's not really how I interpret things. Maybe that's a little bit naive of me, but if you go back and you look at what Elon has done historically, I mean, that first time that he sold Tesla last year, and this was before the Twitter stuff, he had made that Twitter poll asking if he should sell stock even before that, and the stock kind of fell off before that, or after that, before Elon did end up selling. So, if he was the type that is trying to boost and get the maximum value from the sale that he can, I think that behavior would have contradicted that. We also know that he ended up paying more taxes on that. So it's not like Elon's just trying to save a buck and talk the stock up. It doesn't necessarily fit with his historical behavior. Doesn't mean it's not the case. It's just not my interpretation of what's going on. So I'm still excited about what Elon said on the call yesterday. I think we talked a lot about that, but that counter argument, I guess, does not necessarily convince me. So anyway, I think that's an overhang right now until we, get finality on what happens there. I think people are just going to be worried about buying in before Elon selling or trying to front run the sale and whatever that does to the stock. If he does end up selling, like we have talked about before, it's going to have to be a relatively small amount. So, we've seen selling on days that haven't even turned out to be all that significant, like less of a drop than what we had seen today. So regardless, it's all kind of short-term noise. Hopefully in the next week or so that we can move beyond that. But I do think that is playing a role right now in addition to earnings. I think it's just making the earnings reaction look a little bit more negative than probably what it would be otherwise. All right, so a couple things to talk about here with earnings. I know we spent a lot of time on this yesterday, but a lot of things covered that are the highlights. I think Elon talking about the $4 to $5 trillion valuation roadmap that he feels like is achievable for Tesla. Of course, the 1,000 gigawatt hour production target for batteries in the United States. And clearly Tesla excited about the Inflation Reduction Act, EV tax credits and battery production credits, solar and storage credits. There's a lot there that's going to help boost what Tesla is planning. And it's very clear now that we've, from last earnings call to this earnings call, Tesla has made some, what seems to be some pretty dramatic changes in their plans or acceleration of their plans, or at least more communicative about what their plans are specifically in the United States. So I think those have solidified and probably accelerated. So that's exciting. Cybertruck going into tooling, semi-production targets, of course the buybacks. I think that's, we had talked a lot about the buybacks and how that might come to fruition. The path that Tesla seems to be taking here is using their future free cash flow to do those buybacks when they do eventually implement those sometime next year, most likely. When we talked about buybacks, that was what I said was my preferred strategy if it did happen. So, I'm happy about that as well. All right, getting into kind of the things that I think maybe were overlooked or we didn't get as much time to address yesterday. I want to start off with a comment that was made by Zach in in his opening statement. It was kind of one of the first things he had said. And I think it's really not being appreciated. And of course, now I've lost my page here. Okay, so yeah. This is like the third thing that Zach said, basically. He said, removing regulatory credits in Austin and Berlin, our operating margins would have been our strongest yet, and auto gross margin would have been nearly 30%. So I think people look at this and they say, okay, auto gross margin was like 28%. Cool. Like it would have been close to 30, not a huge deal. But you really have to focus in on this. And, Zach reads his prepared remarks and he's very careful with how he's wording things. removing regulatory credits, Austin and Berlin, we would have been nearly 30%. So he's talking about auto gross margin X credits there, not auto gross margin including the regulatory credits. So I want to flip over to Excel and just show how significant this is, because it's, that's a very impactful statement. So let me flip over here, and I am going to take a brief tangent. Let's just keep that in mind, but I'm going to take a brief tangent here and just look at average selling prices, because as I'm going through this is an important part of the analysis. This is my more detailed model, by the way. Parts of it obviously hidden, but looking at this, so I'm looking at average selling prices here for the Model 3 and the Model Y. And of course, these are just my estimates based on what Tesla's reported historically. They don't break that out between 3 and Y, S and X. So I'm just kind of taking my best guess at these, but they should be pretty directionally close. You can see here, going back a ways now, this is, even though we did see a really sharp drop quarter over quarter in average selling prices, which I tweeted about yesterday, a couple $1,000 decline quarter over quarter. Same thing with Model 3 and Model Y. This is still, kind of the second highest average selling price that we have seen for the 3 and the Y over the last, couple of years. If we go back there, it's, kind of probably the second highest average selling price we have seen. So even though we've seen this decline, it's not necessarily falling to a place that is bad. And we've seen Tesla, when they have had average selling prices below this, print margins, near that 30% range. So the context is important. I think people seeing that decline, and even me seeing that decline yesterday, it's kind of like a red flag for, oh, is that going to continue? How does that affect modeling going forward? But it's still in a very healthy place is kind of the main point there. All right, so going back to Zach's comment then about auto gross margin and how much Berlin and Austin impacted that. So again, he's talking excluding regulatory credits, which excluding regulatory credits, Tesla's auto gross margin was 26.8%. So if Zach is saying that that's going to be almost 30%, we're talking about, okay, maybe somewhere in between 29 and 30%. That's a $400 to $600 million difference in gross profit, automotive gross profit X credits. So I've been just kind of playing around with this and figuring out what the impact of the business is from that difference, because this is really important, and people will think it's kind of like cherry picking or whatever. But what Zach is saying there is that those are temporary costs for these factories as they ramp up, and eventually Tesla is going to work through that, and those costs are going to disappear. The extra burden that ramp up is placing on Tesla right now is going to disappear, and that's going to make a huge difference for the business. That's what Zach is trying to emphasize. So, this is the third thing that he said in the entire call when he talked about a lot of things for a reason. It's because it's very important. So I've got this little number in gray here. That's what we're trying to match. And I'm just going to show you what this basically means in terms of cost of goods sold, what it's going to do to earnings per share. If we just say, okay, let's try to isolate out the impact of those temporary drains on profitability from Berlin and Austin ramping up. So what that ends up being, it's a $1,500 hit on every single vehicle from a cost of goods sold perspective. So if we take that out, that gets us to our profit number that we need to get to make our auto gross margin X credits about 30%. So 29.5% in this example. And again, I took out $1,500 of cost for each vehicle. That's what the drain is here from that impact. So this has huge implications throughout the entire business. You can see auto gross margin, including regulatory credits, pops up above 30% in that scenario. Auto profit, $5.7 billion. If we flip over to kind of how this flows through the rest of the business, you can see all the different line items here. Just want to kind of run down through that so you guys can see what I'm looking at. I've got this set up so that it'll add tax. It's not, it's not doing the calculation without figuring out how everything else flows through. And when we get to the bottom here, you can see GAAP earnings per share increases from 95 cents per share up to $1.08, non-GAAP up to $1.19. So this is just from Austin and Berlin, nothing else. We also know that Tesla had a $250 million negative impact to profitability from foreign exchange, and that's going to impact their average selling price too. So not even counting that, this is the kind of increase that we're seeing if we just compare to what the quarter looks like now. So it's in column D here versus what the quarter looked like before. We're looking at 14% increases across, pretty much everything on the bottom line. We're looking at operating margins up to 19.5%, so a 230 basis point increase to operating margins. Same thing on gross margins. So again, this is a huge impact, and you might say, okay, well, it's in the cost structure, like it needs to be considered, and that's true. I'm not trying to say that it shouldn't be considered, but I think a lot of times, and I think this is what caused so many people to be so wrong on Tesla for so many years. People weren't looking at those one-time things and understanding how those would evolve and change in the future financials. So that's all I'm trying to do here is point out that, hey, even though right now we're in this period of time where it looks like Tesla's, at 95 cents per share, the reality is that their business and kind of where they're at is really $1.08 per share. And again, that's with Shanghai ramping up, foreign exchange impacts, certainly a lot of factors, logistics costs, high materials costs. Zach said this is kind of a peak. That should decline hopefully next quarter, 10%. They talked a lot about transportation, how shipping containers have declined as well. So point being, we're again in one of those periods of time where things are suppressed, and they're suppressed by a very significant amount, which this demonstrates. So I found it interesting. I hope you guys found that interesting. It was kind of an eyebrow raiser as Zach was going through his comments, and getting into the numbers today, definitely worthwhile to understand. So I hope that's helpful. The other kind of thing that I wanted to point out here would be production and deliveries. So let me flip back to Zach's comments on the transcript. And here we can see on production and deliveries, we know this, but he said that as we look ahead, our plans show that we're on track for 50% annual growth in production this year, although obviously supply chain risks beyond their control. And on the delivery side, we do expect to be just under 50% growth due to an increase in the cars in transit at the end of the year. So Zach talked about that. Elon talked about that. Elon still said, it's going to be an epic Q4. So still plenty of reason to be excited. But I did just want to quickly take a look at what that means from a numbers perspective as well, because we didn't get a chance to kind of walk through that yesterday. So we'll start off with production. We had 930,000 vehicles produced last year. So to get to 50% this year, we're looking at just below 1.4 million, about 1,395,000. That would require 466,000 about for the fourth quarter, 27% growth quarter over quarter from the 366,000 this quarter. That's huge growth. If we look at Tesla's historical production growth, we can see a couple quarters in that ballpark, but they're pretty infrequent. This is going all the way back to 2017. And I've just put the average and median for all these quarters down at the bottom here. Average sequential growth for Tesla is about 15% in production. Median is 10% though, because you've got a couple of quarters in here where, you're coming off of COVID shutdowns there up at 76%. And then you've got a few quarters in here where the Model 3 was kind of first starting off. So you take those out, or you just kind of balance those out, and really you're looking more at a 10% sequential growth figure. And this quarter we're supposed to see 27% based on what Tesla has just guided from Zach's comments. And hopefully it's even a bit above that, because, he's saying they should achieve that. So for them to be comfortable saying that, the real target is probably at least a decent chunk above that 466,000 level. So a lot of things to be excited about for Q4, even if it might seem a little bit disappointing at first that, they're not going to hit that 50% growth target. It's still going to be a tremendous quarter in terms of the sequential progress. And that's all going to flow through to the bottom line and change the assumptions that are being made about Tesla's business and the fundamental strength. All right, so looking at deliveries then, this is the one that people are more focused on to their detriment. The deliveries here last year, 936,000. So to get to 50% growth this year, they would need 1.4 million, just over. So 1,404,000. That's 496,000 in Q4. So Tesla on the call saying, hey, we're not going to hit 496,000 this quarter. Makes sense. That'd probably be above what they're targeting with production, although we'll see. Could be some upside. But if we're talking about, again, Zach's comment verbatim was, we do expect to be just under 50% growth. Just under 50% growth to me probably implies something like, 47, 48% growth year over year. Certainly doesn't seem like it'd be less than like 40%. So just running through a couple of different growth scenarios and seeing what that looks like for Q4. 40% would be 402,000. 45% is 449,000. So again, I think if you're saying just under 50%, you're probably talking about 45% plus. So I think a number 450,000-ish should kind of be the, ballpark of what Tesla seems to be communicating here. At least that's my interpretation. So again, we're going to see huge growth. I mean, that's over 100,000 additional vehicles in Q4. If they're at that 450,000 level, that would be even more growth than we saw this quarter from Q2, where we had all those shutdowns. Like, this is, as Elon said, going to be an epic quarter. Don't let the fact that Tesla's going to fall short of an arbitrary 50% growth target, despite having to close Shanghai for a few months. Like, don't let that distract you from how good this quarter is going to be, because, it really doesn't matter. 47%, 50%. Tesla is not priced for that kind of growth going forward. So if they can get close to it, it's going to far exceed what analysts are modeling right now. Maybe not for this quarter, but continuing forward. So a few things there that, just kind of were sticking out to me as I reviewed notes and read the transcript and kind of plugged in the numbers today. And again, hopefully that's helpful. Appreciate you guys staying up a little bit later for this, and hopefully we'll be back on a little bit more of a normal schedule tomorrow. But appreciate it. And as always, thank you for listening. Make sure you are subscribed and signed up for notifications.